Hi, welcome to Numerix Video Blog, your expert source for derivative trends and topics. I'm your host, Jim Jockle. The Basel Committee's final ruling on standardized approach for measuring counterparty credit risk exposures was announced in April of last year, where all banks must comply by January 2017. Also on the forefront is KVA. Though not yet required by regulators, KVA is recognized as the cost of holding bank capital against the risk of a trade on all dates into the future. Joining me today for this discussion is Dr. Sergey Izakov, Senior Vice President of Quantitative Research at Numerix. Sergey, welcome.
Thank you, Jim.
So, Sergey, perhaps we could start from your perspective as it relates to how prepared are the banks? Have they incorporated these calculations, or where are we as it relates to the timing of those rules and the rollout?
Okay. And as you said, Jim, this new regulation, recent regulation from Basel Committee appeared only in April last year. But it is final regulation for counterparty risk capital that corresponds to realized defaults. And there are actually two types of capital in counterparty risk. The one is this for realized default, which was issued in April last year. And the other one is a CVA capital charge, which is Basel III rule. Now both are defined in the final form, so banks have to work to implement that. But because the deadline is January 2017, it's not clear how many banks actually did implementation, did this work.
So I want to talk a little bit specifically around KVA. There are many methodologies right now, and no standardization as it relates to the calculation of KVA. Perhaps you can shed some light and insight as it relates to these methodologies, and do you see an emerging standardization similar to what we've seen in terms of CVA through the rollout coming to the market at any time soon?
If you look at this table, which represents different types of capital and KVA, you can see that KVA, in fact, is much more complex quantity and than CVA or DVA or even FVA, because KVA corresponds aggregation of future capital for different types of risk. In this table, you can see that there is a component corresponding to the market risk, and then two for the counterparty credit risk. And yes, and you can add even more, say, operational risk in the future. And even for capital, which is capital as of today, calculation as of today required by regulators, there are different approaches. The standardized approach has been formulated recently in final form, except for market risk. For market risk, the standardized approach has been formulated in a preliminary form by this fundamental review of trading desk document, which is in one of the boxes in this table. But in addition to the standardized approach, there are approaches that are based on simulation of exposures. So for each box of standardized approach, there is a corresponding approach to, which is called sometimes the IMM approach, internal model approach, for computing capital. And then if you go to KVA, to each of these 6 boxes of capital, there is a corresponding KVA. And also, the KVA can be computed by different ways, in different ways. And for standardized approach, when you can compute capital following closed formulas, the KVA computation is also simple. You can call it analytic KVA. But the most complex approach is to incorporate actually simulation, both scenarios for computing future capital on future dates.
Real world or risk neutral?
That's both.
Okay.
Yes, and then on top of that, simulation of your portfolio on those scenarios. And as you said, also, ultimately, you have to use real-world scenarios to compute KVA, which is also different from FVA, for example, and CVA. So this is a very complex field, and there is ongoing research that is actively discussed at conferences. Results are presented, and this is work in progress at this time.
So let's talk about the latest VA to the XVA party, if you will, the MVA, the margin variation adjustment. So, as everyone in our field is fully observing, is the imposition of margin on OTC derivatives, non-cleared, whether that's initial margin or variation margin, which introduces the MVA adjustment. Perhaps you could tell us a little bit about how you see the development and the relationship between the KVA and ultimately the MVA once these rules are rolled out.
Well, MVA corresponds to again, there are recent regulations actually as of March of this year, very recent, that were issued for these rules for margin rules for OTC derivatives. And initial margin, variation margin. There is again a standardized approach to that, which is in final form now, and it will be in effect the September the 1st of next year, which is very near. And but for MVA, this is a pretty new concept, but by analogy, in all this valuation adjustment, of course, if you have a computation of margin, you have to include the effect of that computation into your price, like for other valuation adjustment, XVA and KVA also. So this concept methodology appeared, in fact, only this year, but it naturally fits into the valuation framework, XVA valuation framework, as a natural component. So if you want to account for initial margin, you have to account for MVA.
Well, Sergey, thank you so much, and clearly we have some milestones that we're going to have to be watching, and I would love to have you back for further discussion, especially as we start seeing a little bit more standardization and clarity come across the market. And of course, on the Numerix video blog, it's our goal to examine the topics that you want to talk about, so please keep the conversation going on LinkedIn or on Twitter at NX Analytics. Thank you for joining us, and Sergey, thank you so much for your insights on the topic.
Thank you, Jim.
We'll see you next time.